I'm all about show me the money. Like, how do you make money? How do you drive profitability? How predictable is it? And can the business continue to perform that way going into the future?
Welcome to Price Discovery, Money and Mindset. Go under the hood with Jordan Rodriguez, a certified financial planning professional and certified exit planning advisor, as he explores the art of balancing wealth with personal fulfillment. We'll hear strategies and stories from industry experts, business owners, and thought leaders about navigating the complexities of high net worth families and businesses. Without further ado, here's Jordan Rodriguez.
Hello, friends, and welcome back to the Price Discovery Podcast. Today's guest is Shina Culberson, the president of Quist Valuation. This is a really important episode because Shina takes us through the fundamentals of business valuation, what actually goes in to valuing your business, and more importantly, some of the mistakes that she sees business owners make that hamper the value of their business. Shina Culberson, thank you so much for joining us on the podcast. I'm really looking forward to the conversation today. I was introduced to you through the Exit Planning Institute. You specialize in valuations, and I'll link your bio and everything in the show notes. But I think a really interesting place to start the conversation is you have a document that you have on your website. It's the Valuation Roadmap, and you dive into 4 different phases of the business owner journey. I'd love if you could touch on those 4 phases at a high level.
Yes, Jordan, thanks for having me this morning. So when I begin conversations with clients, the first thing that I am trying to find out is, where is that business owner in their business life cycle phase? And I generally break out where a business owner is in 4 primary phases. The first phase is just purely discovery, and those business owners typically look like they've been in the business, they haven't spent much time working on the business. They may never have had a formal valuation done before, and they may not really understand exactly where their value drivers are in the business, but they're interested. They're at a point where they understand revenue, they understand profitability, but they really want to understand the underlying drivers of that company and what's driving its value. So they're purely in this sort of discovery phase. Typically, I find that once you start to peel back the layers of that onion of the value of the company and what's driving it, things in the business start to percolate.
Mm-hmm.
And then business owners realize, oh, I need to put in place some initiatives. And then they start to migrate towards this sort of operational growth phase. So issues that typically arise in this phase that I have found are things like, gosh, I've got some key members of my management team that if they left the business, I'd be in real trouble. I like to put in place either some sort of formal equity plan or phantom equity plan to secure them. So that's all about building foundational growth for your business.
Sure.
Right? And we help in valuation in that way. Or it could look the opposite, which is, I've always wanted to engage in these initiatives in my business, but I have a business partner that really doesn't want to run the business the way I do. They want a lifestyle business, and I really want to grow the business. So I think this might be the time for us to part ways so I could really engage in driving value to the business. So again, it's triggering a specific need for evaluation, but again, setting the foundation for future growth. So those are just kind of 2 basic sort of examples that I often find. So phase 1 is discovery. Phase 2 is operational growth. And then the next phase that clients tend to migrate towards, once they've been in the business, they've grown the business, or the business is stabilized, and they're starting to think about, okay, what's life going to look like after, my business maybe they start thinking about transitioning or selling their business. Well, there's a number of different personal financial strategies that they can put into place. And I call that kind of leaving a legacy. What's that going to look like? How are they going to leave a legacy for their children, their family, their charity of choice? So there's a number of tax strategies around that. And so that is a totally different sort of phase, right? How am I going to put my stamp on not just the business, but other parts of my life, family, community, etc.
Right.
So that's the leaving a legacy, what I call leaving the legacy phase. And then the last phase is always sort of that exit phase, that transition phase. Am I going to transition business internally, externally? So again, when I first meet with a client, I'm trying to figure out where are they in this life cycle of the business? What sort of objectives might they have? And clearly none of this is super clean all the time. A lot of times people come in thinking, oh, I want to, I'm thinking about, well, this is typically what happens. I'm so ready. I need to exit my business. It needs to happen now. I'm ready to exit. But then what really is the case is we have to kind of back up a little bit, engage in that discovery, figure out if the foundational pieces are in place, make sure they're set up personally for that exit. And then we start talking about exit. The conversation obviously initially can touch on all those phases, but I think it's nice to break it out that way, because then you can orient the business owner to really understand, okay, how do I get from A to Z for my ultimate objectives?
Wow. So there's so much that you said in there that I'm going to want to circle back on that I know we'll save time to. It might be helpful though, before we go any further, just in its most basic sense, what goes into a valuation equation?
Okay. So valuation is, so we can talk about the technical approach to valuation, right?
Sure.
So let's start there. And then we'll talk about maybe like different perceptions of that. From the most technical perspective, valuation, there's three primary approaches to valuation when you assess the value of a company. One is the asset approach. So that's clearly what's the value of the assets on the books, your tangible assets minus your liabilities, and that's your net asset value. For most companies, this provides a floor level of value. It's like if I had to liquidate my company today, what would be the assets less the liabilities? So that's an asset value. The next approach to value, to establishing value, is a market approach. That approach involves going out into the marketplace, looking at other businesses like your business that have been bought and sold, seeing at what multiples of maybe revenue or profitability they've been sold at, and then trying to make a comparison about what that means for your business. So if I'm an engineering services firm, I would go out and look at transactions of other engineering services firm. If I generate $10 million of revenue, I would like to look at other companies that are of similar size. If I've been around for 40 years and have a certain amount of employees, I want to try to make as close of a connection in comparability to my company to understand what the value is of my company based on what another business has sold for.
Right.
Some businesses are big enough that maybe looking at publicly traded companies makes sense, but the majority of businesses are so small that that doesn't make sense. But there are still some privately held companies that are really big where maybe looking at a publicly traded comp makes sense. And then the third approach, standard approach, is an income approach. And that's all about what is the cash flow generating ability of the company and what's the predictability of that cash flow and how predictable is that cash flow into the future. That's kind of how I think about income approach. So all those approaches to value are valid. They don't always apply to every company. Facts and circumstance matter about the industry, the strategy, the phase of that business. I think most people tend to migrate towards a market approach in terms of establishing value for the company because it's simple to understand. It's two numbers. It's take a company's profitability, apply a certain multiple to it, and you get an indication of value. Pretty easy to understand. But the downside to that is that it's dependent on market conditions, economic conditions. If you're looking at a company that maybe sold, let's take, sold pre-COVID, does that mean that you're going to get the same multiple today?
Right.
Even though you might be very similar in business description and size. So there's some downsides to it. And of course, just the availability of information can be hard to get. And so, there's pros and cons. I personally like to look at an income approach because it helps with a business owner who may be doing an inside sale to a key employee, a management team, because often those transactions are funded through the existing cash flows of the company. So I'm all about show me the money. Like, how do you make money? How do you drive profitability? How predictable is it? And can the business continue to perform that way going into the future? And what are its opportunities? So I personally like to lean towards an income approach because I think it's more fundamental to the company itself. It's solely focused on the specific performance, operational management, financial management of that company. It has nothing to do with some other multiple of some other company that may or may not be related. But it's not easy always to conduct. You got to have an idea of what your next couple of years might look like. You have to have some pretty tight financial management so you understand, what your expense base looks like, et cetera. So not always easy to perform. But those are the basic approaches to valuation and in some of the pros and cons to them.
So there's definitely different methodologies, it sounds like. There's also different types, and I'm hoping you can take a minute to describe the difference between a certified appraisal and an estimate of value, and then maybe tie it back to the different phases and when a business owner might be more likely to use one versus the other.
So I think that there are estimates, as you noted, there are estimates of value and there are certified valuations. And really the difference is, I would say, around three primary factors. One is precision, right? So just an estimate of value in itself implies less precision, whereas a certified valuation is more precise. Typically, a certified valuation is going to encompass all of those approaches to value that I described before. It's going to reconcile around those values. It's going to get down to like the penny of what someone thinks the value of the company is worth.
Yeah.
Whereas an estimate value is typically, maybe there's only one approach used. Maybe that's a market approach because it's easy and straightforward. And an estimate value could be very valuable in that discovery phase where precision's not really the primary objective in the discovery phase. The discovery is, we're just starting to peel back the layers of the onion and find out about the company and what is, high level driving value. We don't need precision during that phase of the business owner. But as the business owner moves towards actually maybe letting a shareholder buy in or having to buy out a shareholder in their business, I think people on either side of that table really care about precision at that point.
Absolutely.
If you are moving towards leaving a legacy, well, typically those are pretty complex tax planning structures. So the IRS really cares about precision. So it's kind of, as you move along these phases, that's where a certified valuation is going to be really important. So you've got a couple keys. So one is kind of precision. The second is, like I said, the number of approaches that might be implemented between an estimate of value and a certified valuation. And then ultimately, I think the purpose is another factor that drives whether an estimate of value or certified valuation is appropriate. So again, if you're in a discovery planning phase, estimates of value can be perfectly fine and they could be quick and they can meet the needs of the business owner. But as you move towards these other phases where there's regulatory litigation or compliance issues, that's where a certified valuation comes in. And when we take providing certified valuations very seriously, because we stand behind that opinion of value that we're giving to a business owner. And we know that we might be called up by the IRS or the SEC or the company's auditors to defend that valuation and explain it. So we take that terminology, like in our world, we take it very seriously in terms of that certified valuation.
Sure. It sounds like you need to, right? Nobody wants to get a call from the IRS and not have the right numbers, right?
That's never any fun.
So if we stick with the discover phase for now and talk about the three gaps, the profit gap, the value gap, and the wealth gap, I always come back to when I'm talking to business owners about, this discover phase, they kind of ask, why should I care what my business value is? I'm not looking to sell anytime soon. And I do go to the three gap conversation. Will you go over the three gaps and kind of how they function in the discovery phase and why a business owner should care about what their business is worth, even if they're not looking to sell or exit or transition anytime soon?
Yeah. So for us certified exit planning advisors, there's three key sort of metrics that we're trying to get at. And so the first one that is the profit gap. And what the profit gap means is let's go back to that engineering services firm. If I'm an engineering services firm, I'm generating $10 million in revenue, $1 million in profit, I've got a 10% margin. So how does my profit margin compare to my industry? So the first step is to look at industry peers and say, okay, so if I take these industry peers and I plot out what their profit margins are, I can see that on the low end of the range, some engineering services firms are operating at a 5% margin. Maybe best in class, those engineering services firms are operating at a 30% margin. So if my engineering services firm is operating at 10%, but best in class is 30%, my profit gap is that 20% differential. And when I think about that 20% against my $10 million in revenue, that's a profit gap of $2 million. So the first question is, how do I, as an engineering service firm, just operate compared to my peers? And am I operating below average, or above average? So that's first step, is just establishing what that profit gap is. Then the second step would be determining the value gap. And when we talk about value gap, then we start to think about, well, if I'm operating at a 10% margin as an engineering services firm, and let's say 10% is, just to make this math easy, and let's say at an average profit margin, the average multiple profit margin for my engineering services industry is 2 times. But if I were operating at the best-in-class profit margin, which is 30%, then the best-in-class multiple would be 4 times. So now if I had a 4 times multiple and I apply that to my best-in-class profit margin of 30%, then that gives me my high end of the value range. So it's 3 million times 4, that's $12 million. But I'm at 10% and I'm only getting a 2 times multiple. So 10 times 2, that's 2 million. So all of a sudden my value gap is now $10 million.
Yeah, pretty big.
Quite the big, right? So then the question is, as a business owner, what do I need to do to close that gap over time? And how do I work my team of advisors to make that happen? So then finally, that's your value gap. And then finally is your wealth gap. So then folks who would work with you, Jordan, you would say, okay, outside of your business, what are all the other assets in your portfolio? How do you want to live your life after you sell your business? What does your retirement want to look like? Who are your children? What's your family? What do you want to do? You might do an assessment and say, gosh, when you enter retirement, you need a wealth number of, I'm going to make this up and make it big, $50 million. Okay. But when we count your portfolio and your real estate and all your other financial securities and assets, you're only at 30 million. So you've got a wealth gap of 20 million there. Okay, well, we just established when we looked at the business today at 10% EBIT margin and a 2x multiple, the business is only worth $2 million.
Right.
So how do we get the business to fill that wealth gap? And we know we can do it because we just said we're leaving a big chunk of money on the table between that 2x multiple, 4x multiple, $1 million EBITDA versus, $3 million EBITDA. So we've got about $10 million to work with in our business that could help fill that wealth gap for the business owner over time. So those are kind of the concepts that we're trying to run through with a business owner and try to come at their financial position holistically, including both their personal financial profile as well as their business profile. I can't remember now. I was long-winded. I can't remember the second part of your question.
Well, no, you covered the big three, the profit gaps, and I think you did a really good job. This was actually the next question. You did a really good job of explaining how valuation ties together the personal, financial, and business planning, because that's what's lost on most of the business owner clients that I work with, because everybody in my industry says, we're going to do holistic financial planning, right? And then push comes to shove, you're working with a business owner and you're doing financial planning and you're ignoring 75% of that pie chart on the screen because it's a closely held business that you're not touching. You just described how valuation in every phase of the business owner's journey makes sense. Like, it's relevant. They need to know what their business is worth at any given time because there's 3 different sets of planning. Now, when I use the terms business, attractiveness, and readiness, sometimes I've met with blank stares because those are just words. I'm hoping you could explain, like, from your perspective, when you're running valuations at any different phase, how business attractiveness and business owner readiness factor in to valuation, and maybe some common mistakes that you see or common pitfalls where businesses aren't attractive or ready for whatever reason.
So, yeah, I think an easy way to think about business attractiveness versus owner readiness is business attractiveness is the attractiveness of the business from someone external. How does someone from the outside view your business? So from the outside in. Owner readiness is kind of from the inside out. How ready am I as a business owner in having my business set up, and how ready am I? So it's kind of inside out. So let's start with business attractiveness. So this is the external, like, I'm looking at your house. What is very attractive about the outside of your house, right? So typical things that I look at in terms of business attractiveness, and these are also common pitfalls, right?
Mm-hmm.
So which is customer concentration. So the mix of your customers. I just had a client that had like 35% of their revenue was being generated by a single large enterprise client. And it was great in the beginning because they had a 3-year contract in place. They scaled their business to meet that big enterprise client. But at the end of that contract, they put that contract back out for RFP and they did not win it. But they had put all their eggs in sort of supporting this one large enterprise client that was also, a reference client for them. But the industry got overly competitive and they just didn't win the contract. And it was a huge hit on their valuation. So customer concentration, I think, is always sort of like, okay, how diversified is your customer base? How well can the business withstand if they lose that key customer? again, outside in business or customer concentration. The other thing that we look at from outside in is sort of systems and processes. I think is another. How well can that business perform on delivering services, products and services on a consistent basis? There's consistent high quality products and services. Someone goes on vacation, gets ill, their functions are documented, the business keeps running smoothly. So systems and processes and having those documented are really key for business attractiveness. And then the other thing that we look at are, again, outside in, is what are the kind of the barriers to entry for any company in the industry that they operate in, and how do they compete then, right? So if you have low barriers to entry, then how is that business, what sort of brand value proposition are they putting forth? How are they securing customer loyalty? So we're kind of looking at their market position and what they're doing to secure that, and how resilient is that for the company.
Sure.
Some of the aspects now, when you think about owner readiness, have to do with, do they have all their corporate documents in place? Meaning, I think any investment banker will tell you that one of the things that sabotages or delays transactions is business owners don't know where all their documentation is, right? It's especially for businesses that have been around for a long time. So do you have all your corporate documents in place? Do you have all your contracts with suppliers, with your customers? Is that all available and organized? Do you have all your employment contracts and things in place? So making sure you have good governance over the company and know where that documentation is, that's a part of being ready to transition and transact in your business. The other key factor that is a big one for us is owner dependency, or the business's dependency on that owner, and what we call key man risk. So, and this is like the pot calling the kettle black for sure. But if you're a business owner, you can't go on vacation without checking your email and your phone on a daily basis. That business you would tell me that business is really dependent on the business owner. And what happens when you try to sell that business and you're like, oh, I just need to get out. I'm so tired. I don't want to work in this business anymore. That could be a real deterrent for valuation and for value in the business owner trying to achieve their overall objectives, which is selling the business. So that kind of owner readiness is like, internally, how ready are you? And that kind of includes some contingency planning and things like that in case of emergency.
Yeah, I was talking to Scott Snyder of the Exit Planning Institute last week, and he was joking about how he took some time to decentralize himself, and he went on a vacation and left his second in command in charge. And I said, if anybody can pull it off, it's got to be you, right? The president of the Exit Planning Institute. And he said, look, even for me, it was a difficult experiment, but they pulled it off. Now, a different part of the conversation we had was the State of Owner Readiness survey came out for 2023. They did a national survey for the first time in 10 years. And I asked him the question of trends that he noticed throughout the course of the past decade. Now, you've been doing this for 2 decades now, and I'll ask you the same question. Even if we just talk about owner readiness, business attractiveness, have people been getting better, worse, kind of staying the same over the course of the past couple of decades when it comes to those 2 factors?
So that's a great question. We actually did a similar survey here in Colorado, and I don't know, I think the trends have gone a little bit better. One, because I think there's more conversation around the need to prepare, but I don't think the percentages have changed all that much. So I still think that you will find that the majority of business owners will say that they want to transition their business over the next 3 to 5 years. The majority of them will say that, especially with the demographics and the baby boomers coming up and really wanting to sell their businesses, but very few of those business owners have actually prepared and put in place any specific plan to do that. And part of that is just honestly is as business owners, we're so busy being in the business, right? Being functional, feeling good about ourselves that we are, being proactive and like really working towards meeting our customer needs and all kinds of stuff. There's very few business owners really take the time to work on the business. And my experience has been that it doesn't take, it's pretty amazing. I don't think it takes a huge percentage shift to make a big difference in how that business operates. So imagine if a business owner is working, they're in the business, let's say, outside of HR administrative, they're like actually in the business 80% of the time. If they could drop that percentage down to even 60% and give themselves one full day a week, right? Just to work on the business and on transition strategy and making sure all the seats are filled with the right people, that will make a big impact. And that's just a 20% shift in that business owner's overall sort of composition of their work hours.
Yeah. And I think that's a great tie back actually to one of the questions about why should a business owner care during this discovery phase, what their business is worth. And you made a really good point that the precision doesn't necessarily matter, but it's really a function of what the value drivers are. And you just hit the nail on the head for exactly why they should care. If they're able to take X amount of percentage of hours worked, however we want to think about it, and spend time enhancing those value drivers, protecting those value drivers, they can see on a monetary basis how much more valuable they've just made their enterprise. And I do think it's a paradigm shift for a lot of them. They've never really thought of it that way. It's top line, bottom line. I'm too busy to think about business transition because it's 20 years down the road. But sometimes that timeline is dramatically shortened due to factors out of your control. And sometimes you just need to know the number because somebody might walk in with an offer that you can't refuse. I think I've always got to ask this question. What's your favorite part of the job or one of your favorite parts of the job?
Oh, my favorite part, honestly, my favorite part is sitting down with business owners and just talking with them from a peer perspective, because I'm a business owner, they're a business owner. I think it's always interesting to hear how they approach different challenges in their business. I always learn something because I always take that back and go, oh, could I do that in my own business? And it is, in my decades of experience in working with all kinds of businesses, I will tell you that some of the most impressively run businesses are ones that you wouldn't necessarily think that would be at the top of the list. And I'm talking like doorknob manufacturer or HVAC provider. I mean, I've seen some incredibly run businesses and they are not necessarily the shiny, cutting edge technology or biotech company, but they are sometimes just so well run and so attuned to exactly what metrics that they're trying to adhere to in terms of running efficiencies. So, it's interesting. All businesses are different and all businesses have their strengths and weaknesses. I mean, that is just, no business is perfect. But I really love talking to business owners, and I love when I meet just these sort of like what you would think about really boring businesses, but they're running them so amazingly. And I always walk away going, gosh, if they can do it, I can do it, right?
And I'm sure the flip side's true too, where you have the business that everybody knows, it's a big one. The CEO's got all sorts of alphabet soup after their name. And if you peel back the onion and look under the hood, it's not necessarily as a well-oiled machine as you think it might be. I think an interesting last question to leave you that isn't a common thread that I'm asking a number of other guests, but it's more specific to your industry. You're a valuation expert. Your company produces valuations for business owner clientele. What sort of role do you see AI playing in what you do, kind of in the short term and the long term? Is it a threat or is it a supplement?
That's a great question. I have a personal kind of opinion about AI, which is, I personally like AI. I think it has made our business more efficient. Some of the things that we've done with AI is, I have a whole team of financial analysts, and they love numbers and they love to be in the models and the spreadsheets. The things that they don't necessarily love to do, but is a necessary function of what we do, is write, right? Document all their findings in a narrative report and put that in the narrative report. So I found that AI has actually helped them with the writing. They could put down some bullet points. They can put down some incoherent thoughts. The AI can help them generate that in a more cohesive, coherent way that they can put into the report, and it's made their life easier. I think on the flip side, will AI replace us? I think it's hard to replace the experience. Like I said, it's easy to apply a multiple to a number and say, here's the value of your company. But it's not as easy to ask the right questions to a business owner to really understand what's driving the business and really understand the nuance of what is happening that's not being said.
Of course.
So I always think I think that experience in working with, we work with hundreds of businesses a year. We've been around for 40 years. We've done thousands of valuations. And so just having that Rolodex of sort of experience and context to compare businesses to is very valuable. So, but I think AI will play a role either making businesses more efficient or trying to fulfill some of those more basic functions for our industry, like many other industries.
That's well said. Well, Shina Culberson, I appreciate you taking the time today. You've been so gracious with your time, and I think our listeners are really going to benefit from your insights, and they might be giving you a call because I know a lot of people are going to be inspired that they should probably get their house in order and get a better understanding of, no matter what phase of their business lives they're in, they need to know what their business is worth and how they can improve on that value.
Well, I appreciate the opportunity to be here with you, Jordan. It's been great.
Price Discovery Money and Mindset is brought to you by Wernick Wealth Managers and Chagrin Valley Business Strategies. Opinions expressed by Jordan and guests are their own and do not represent investment advice, solicitation, or the like. For more information and resources referenced in this episode, be sure to check out the show notes. Thank you and see you next time.